The Federal Reserve meets today and tomorrow. Here's what our central bank must do to help our vulnerable economy, but won't. Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. Will the Federal Reserve cut interest rates when it meets this week? We'll get the decision on Wednesday. The consensus is that the central bank will hold steady. Its excuse will be that it wants to see how President Trump's tariffs will affect the economy. This is a mistake. After a strong start, the economy is getting a bit wobbly. No wonder. Markets are assuming we'll get those trade deals within that 90-day suspension. They're also assuming that somehow we'll get things squared with China, since that economy's in deep trouble and the Xi Jinping won't do something about Taiwan to rouse up nationalist sentiment and divert people's attention from dismal prospects. In the meantime, however, the current lack of what the tax and tariff rules will turn out to be will weigh on the economy. But the Federal Reserve shouldn't sit on its hands. Unfortunately, the institution is hobbled by hubris and a flawed operating model. The fallacious premise on which it operates is that prosperity causes inflation. From that faulty assumption, the Fed thinks you cure inflation by depressing economic activity. The Fed doesn't distinguish between higher prices brought on by regulations, taxes, and disruptions to production, such as the pandemic slowdowns, and price changes caused by the dollar losing value. The central bank can't do anything about higher costs brought on by tariffs, so it should drop that false rationale. It can very much impact, however, the value of the dollar. The surge in the dollar price of gold recently means inflation is coming in the next year or so. Just recall that the upswing in gold in 2019 presaged the recent unpleasant round of inflation. This was a rise in prices made worse by what our government did during the COVID crisis. So what should our central bank do? To save face and not looking like it caved into Donald Trump, it should slash the interest it pays on reserves banks have on deposit at the Fed. The rate is now 4.4%. Knock it down in half and make it clear that banks won't get gigged if they boost lending. Thanks to a series of blunders by governments since the economic crisis of 2008-2009, economies everywhere are going to need liquidity to prevent a deadly wave of defaults, or at least be able to handle them in an orderly manner. Won't this fuel monetary inflation? After all, the dollar has been weak. This is where the Fed must declare that it is abandoning its bogus prosperity causes inflation dogma and will henceforth work to keep the dollar stable in value. The best measure of that is the price of gold. To show its positive intentions, the Fed should urge the Treasury to issue some bonds backed by gold. Treasury Secretary Bessent has declared that the administration wants a strong dollar, and selling bonds would be a proof of this. The Fed, which has long been afflicted by hubris, should do one other thing this week, and that is halt its obscenely lavish revamp of its Washington headquarters, including a special elevator bank for high-level officials to be whisked to an exclusive dining room. The New York Post revealed this $2.5 billion project that is already $600 million over budget and won't be completed until 2027. A sensible monetary policy and abandonment of its hubris will make the central bank again an institution we can trust. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions. I look forward to being with you soon again.